Everyone, today we're going to see about the deficiency account from the subject is accounting for partnership. A deficiency is a numerical difference between the amount of tax that the taxpayer or tax-paying entity reporting on a tax return and the amount that the Internal Reserve Service IRS determines is actually owned. The term only applies to stock fails and not to surplus. The deficiency account is corrected to show the balance sheet or financial statement of a financially understandable enterprise or company. It usually is the values associated with the total value of the assets. It also individuals and shows the cases of the difficulty and net losses that the enterprises has. Deficiency is shown by an exist right slide over the left slide. The terms contributed to deficiency includes bad debts losses within a particular period as shown on the profit and losses accounts, drawing expenses and estimated losses on asset realization such as on property, machinery or stock. If current asset are less than current liabilities, an entity has a working capital deficiency. It is also referred to as a working capital deficient and negative working capital. Working capital is part of operating capital along with fixed assets such as plant and equipment. The deficiency accounts is prepared in a similar format to the statement of affairs, with the liabilities listed first followed by the assets. The difference between the two is the amount of the deficiency, which represent the amount by which the liabilities effort exceed the asset. It should be noted that the deficiency account is only prepared when a company is to enter an insolvent voluntary liquidation. An explain of the deficiency account can be filled far below. The term deficient is used within the stockholders equity section of the corporation balance sheet in place of retaining earnings of the balance in the corporation's retained earnings account is the debtor balance. In other words, the corporation has a negative amount of retaining earnings. Asset deficiency is a situation whether the company liabilities exceed its assets. Assets deficiency is a sign of financial distress and indicates that the company may deficient on its obligations to create creditors and may be handed to bank. The deficiency account is prepared in the similar format to the statement of affairs with the liabilities listed first followed by the assets. The difference between the two is the amount of deficiency, which represent the amount by which the liabilities exceed the accounts assets. Deficiency is the difference between the amount of tax and that the taxpayer report in their income tax return and the tax that is assessed by the income tax department. It is not a word described under the Income Tax Act, but such difference are maintained as deficiencies in the taxpayer day by day life. Deficiency account refers to an account that supplements the balance sheet of the financially weak company, indicating the realization of values, that how they are insufficient to achieve the claims of the creditor and the cases of deficiency. The financial adjustment on the deficiency account is the difference between the book value of the asset of the company and the estimate to realize value in the settlement of statement of affairs. This is the conclusion. Thank you.